For as long as there have been markets, people have dreamed of finding the ultimate edge, some kind of secret weapon to predict the future. And with AI, that dream feels like it's right at our fingertips. But what really happens when these super smart algorithms get unleashed on Wall Street? Well, let's dig in.
So that's the billion-dollar question, isn't it? Can an AI really find those hidden patterns in the market noise, the ones that we humans just can't see, and consistently make the right calls? We're going to look at what the research says, and trust me, there's a really interesting twist.
Okay, before we dive in, we have to get something super important out of the way. This is an explainer. We're looking at what academic studies have found. This is absolutely not financial advice. Every trade has risks, and you are solely responsible for your own decisions. We're here to nerd out on the science, not to give you stock tips. Cool? Cool.
All right, here's our game plan. We'll kick things off with the big dream of AI trading. Then we'll see how it performs in a specific test. After that, things get complicated when we imagine a whole market full of AIs. And that's where we'll uncover a critical flaw before we wrap it all up with the key takeaways.
So, let's start with that dream. The core idea is that machine learning can be like a superpower. It can sift through absolute mountains of data, news articles, social media, trading stats, and spot these tiny, subtle signals that predict which way a stock is going to go. Signals that are basically invisible to you and me.
And look, this isn't just science fiction. Researchers have shown that if you feed an AI the right kind of data, for instance, the legal trading activity of company insiders, it can actually learn to connect those dots. It sees who's buying, who's selling, and uses that to make some surprisingly accurate predictions.
Okay, so that sounds fantastic in a research paper, but how does it work in practice? Well, a group of researchers decided to put it to the test, and they picked one of the wildest, most unpredictable stocks on the planet to do it, Tesla.
So, here was the setup. A study from 2023 grabbed 3 full years of public data on when Tesla executives and other insiders were buying or selling their own company's stock. The goal was pretty simple. Could different AI models use just that data to predict where the stock price would go next? And this was a serious effort. They got the data, they cleaned it all up to make it usable, they used some clever techniques to figure out which bits of information were the most important, and then they unleashed a whole stable of different AIs to see which one was the smartest. It was like a data science bake-off. And the results? Whoa! Just take a look at this. The top-performing algorithm, a specific kind of support vector machine, was able to predict the stock's direction with an incredible 88% accuracy. Others were right behind it. All of a sudden, that AI dream starts to look very, very real.
Let's just let that number sink in for a moment. 88% in a controlled experiment using historical data, and AI was correct almost 9 times out of 10. We're talking about predicting Tesla's stock price here. That is just an absolutely stunning result.
But, and you knew there was going to be a but, right? Here's the first catch. The most accurate model was also by far the slowest. And the fastest model, well, it was the least accurate. So right off the bat, you have this classic trade-off. Do you want the right answer, or do you want the answer right now?
And that trade-off leads us to a much, much bigger problem. See, that amazing Tesla study had one giant asterisk next to it. It was a backtest. It was a simulation running on old, fixed data. Now, we have to move from that sterile lab environment into the pure chaos of a live market.
Think of a backtest like this. It's like letting an AI watch a recording of last year's World Cup final. It can get really, really good at predicting what's going to happen next. But here's the key thing. Nothing the AI does or thinks can change what already happened in the game. It's just a spectator, watching history play out.
So here's the critical question that changes everything. What happens when the AI is no longer just watching a recording? What if it's live, on the field, and its actions, its trades, actually influence all the other players and the direction of the game itself?
This is precisely what a groundbreaking study from the Wharton School decided to figure out. And in the process, they identified a phenomenon with a very fancy name, the negative learning externality. But don't worry, it's basically a simple idea. It's what happens when a bunch of AIs start tripping over each other.
So for this experiment, they didn't just test one AI on old data. No, they built an entire simulated stock market, a virtual Wall Street. Then they dropped in multiple advanced AIs that were all learning and trading against each other in real time, where every single one of their trades actually affected the prices.
So what is this externality thing? Okay, imagine you're in a room with a bunch of people, all trying to listen to a very quiet, beautiful piece of music.
But in order to find the music, some people just start shouting out random notes. Those shouts are like the AI's exploratory trades. And pretty soon, all that shouting creates so much noise that it's impossible for anyone else to hear the actual music.
And this chart shows that exact problem perfectly. That blue line, that's the perfect, optimal trading strategy you want to follow. The orange line is what the AIs actually managed to do. And you can see it plain as day. As you add more AIs to the market, and as they get more money to trade with, the orange line gets worse and worse. It deviates further and further from the perfect strategy. Their collective noise is making everyone less effective.
The consequences here are pretty huge. This AI traffic jam doesn't just mean lower profits for the AI traders themselves. It actually makes the entire market less efficient. It even reduces liquidity, meaning it gets harder for anyone to buy and sell. And the more AIs you pack in there, the worse the whole problem gets.
So we've seen the incredible, almost magical potential of AI in a controlled test, and we've seen this massive real-world hurdle. So what's the final verdict here? Let's put it all together for a quick reality check.
I think the Wharton researchers said it best themselves. Those simple backtests, the ones that produce those amazing headline numbers, can seriously overstate how effective an AI strategy will be in the real world because they completely ignore its impact on the market itself.
So what does all this mean for you? Well, first, a backtest isn't reality. It's the starting line, not the finish line. Second, in a live market, a whole bunch of AIs trading at once creates noise that can hurt everyone's performance, and that noise can lead to lower profits and a less efficient market. The bottom line is this: AI is an incredibly powerful tool, but it is not a magic crystal ball. You always have to think about its limitations.
And let me just say it one last time because it really matters. We've just explored some fascinating academic research. This is not a guide for how you should invest your money. The market is a complex beast, and you should always, always do your own research. And that leaves us with one final thought to chew on. As our financial markets become more and more populated by AI traders, are we actually making the market smarter and more efficient? Or are we just creating a much, much noisier room where it's getting harder and harder for anyone to hear the music?